Good afternoon, and thanks for joining us for our webinar on the Purdue-CME Group Ag Economy Barometer. I'm Jim Mintert, Professor of Ag Economics at Purdue and also Director of the Center for Commercial Agriculture. And joining me are my colleagues David Widmar, who's a Senior Research Associate in the Center, and Michael Langemeier, who's a Professor of Ag Economics and also the Associate Director of the Center for Commercial Agriculture. We're pleased to talk to you about the results from our initial report with respect to the CME, Purdue-CME Ag Economy Barometer. If you have some questions during the course of today's program, you can send us emails, and I think that email address is on the screen right now, or you can call those in as well, and we'll be monitoring both the phone line and the email address during the course of the webinar. So with that, let's kick it off and talk a little bit about the barometer. And the barometer is really based on a survey of 400 people, 400 farmers around the U.S. That we conduct every month. And if you want some details about the barometer, we have done a couple of things. One on our website, which is purdue.edu/agbarometer. We have a document out there that details the survey methodology. And then we also have a short video that David and I recorded a few days ago that actually goes through some of the details with respect to how the questions we ask and the methodology we use to compute the barometer. So we won't dwell on that today, but if you want that information, it is available. So the graph that we have on the screen gives you the details of the Ag Economy Barometer. We've got data on there going back to October, and that's because we did collect some data in the background before we did our first release here this week. So we started collecting data in October of 15. And continued to collect through March of 16, and that was used to establish our base for the barometer, and then the April data is on there, as you see on the slide. And so you can tell, looking at the data, producers' perspective about what was taking place in the ag economy was actually worsening as we moved through the fall and into the winter and actually into early spring. And then we saw a rebound in the month of April as we saw that barometer value increase from 85 to 106 in April. So if you think about that, that was a pretty big jump in a short span of time. And David, I'm going to let you talk a little bit about a couple of the components of that index, and then we'll talk about maybe why we saw that change in the index value during the month of April.
Yeah, so within the actual index itself, we can divide the questions into two groups. One of the groups creates the index of current conditions, thinking about how producers are evaluating their operation today. The second group of questions that we can split out provide us an index of future expectations. So what they're thinking about for their operation a year to up to 5 years out. When we graph these two over time, we can provide a little bit of insight as to are they concerned about today or are they concerned about the future. And what we can see is that in the browner color is the index of current conditions, and as we can see, that's moved around quite a bit. We saw a peak of 125 back in December after harvest. Corn prices were relatively strong. Then we'll get to that here in a little bit. But then we slid pretty steadily up through March, hitting a low of 77. And then, of course, in March, that index of current conditions rebounded up to 107. The second component, again, is in green, the index of future expectation. That's been a relatively steadier, less variation from month to month. And that's kind of a forward-looking expectation that producers have about the future of ag.
So David, it's interesting to me looking at the data on the screen there. If you look at the change in that index of current conditions versus the index of future expectations from March into April, there's a difference in those two, isn't there?
Yes, there definitely is. And what we zoom out a little bit, when we saw the index dip from December heading in through March, on the previous slide, that was really driven from that index of current conditions. That producers, we've been talking about this, what was going on. We saw commodity prices, as we'll look at in the future, kind of dwindling down. We also saw producers planning for the upcoming season. They were doing their budgets and they were doing their financial planning with their bankers and lenders. And so we've seen that index really, the current conditions, move a lot more here recently, and then it spiked again in April.
So let's take a look at some of the reasons why we saw that change in the index value, especially during that April time frame. This is a chart of nearby corn futures from CME Group, and as you can see, one of the things that was really driving that change, especially in the index of current conditions, was the dramatic rise we saw in commodity prices, especially corn and soybean prices. We don't have a chart for soybeans, but a very strong rally in both those commodities starting about the 1st of March. Our surveys were conducted at the middle of each month, so it was that rally was underway a little bit, maybe just barely starting when we did the March survey, but clearly we had roughly 6 weeks of a rally underway in both of those markets when we did the April survey, and I think that was one of the big drivers behind that increase in the index value. And Michael, maybe to put that in perspective, we want to take a look at some longer-term corn prices.
Yeah, certainly. Certainly, Jim. This is looking at monthly Indiana corn prices from January 2000 up to the current information we have for March 2016. The horizontal red line and the horizontal green line represent average corn prices before 2007, pre-ethanol boom, and post-2007 with respect to the green line. And you can see right now, Jim and David, that the monthly corn price has been below the average since 2007 for several months in a row. The average, if you're looking from 2007 to 2016, is about $4.85. If you go back to pre-2007, the average is $2.20. One of the points I want to make here is even though prices have declined in the last several months, we're still well above where we were prior to the 2007 period. And that's important to keep in mind.
Yeah, and if we take maybe a little longer-term look at prices, and we've got some annual averages. So these are the U.S. national average cash prices that USDA reports. So these are on a marketing year basis, not on a calendar year basis. And we've got those on the screen going back to 2005. And you can see the big peaks in corn prices we had, again, mirroring what Michael was just talking about with those monthly prices. But if you look at particularly 9, 10, 11, and 12, some very strong prices. Then the decline got underway and showing up in 13, 14, 15. And as you think about that index of future expectations, those prices are showing some recovery, and these are the FAPRI prices forecast for those out years, still not getting back anywhere close to the levels that we had just a few years ago. And so when we think about the lack of long-term optimism in the ag sector, I think it's tied very heavily to the fact that we're looking at some prices that are well below the prices we saw just a few years ago, and producers are very cognizant of that. We'll talk more about that later with respect to the margins. But
I want to make one point with respect to this chart, guys, and that's the fact if you look at 15, 16, and 17, I think you can look at those points and make some inferences about some of the charts we have with respect to the Ag Economy Barometer. If you look at 15 and 16, 16 is slightly lower. And so when you compare it to last year, it looks as bad as last year looked, and that's important when we think about the Ag Economy Barometer. Some of the barometer also talks about future. If you look at 17 there, it looks a little better, and I think we're picking up these things that I'm pointing out here in the Ag Economy Barometer.
so let's take a look at commodity prices again.
Right, so what we've looked at earlier is actual reported data and forecasts. We've also asked producers what their expectations for commodity prices are for the next year. And the question is very simple. It asks for corn as an example, do you expect corn prices to be higher, lower, or about the same 12 months from now? We've asked that question at 4 different times in the history or looking back through our survey collection data point. And when we saw producer sentiment, the barometer, the index of current conditions reach that low point in March, we had between 20 and 25% of producers reporting expecting lower commodity prices in the next year. I think we saw that building throughout the summer. So not only were commodity prices getting lower, in reality, the expectations of even lower prices were being weighed on producers' minds. So moving into April, we saw in the earlier graphs, prices have improved, but so did producers' expectations. Fewer producers in April relative to March are expecting lower commodity prices a year from now. So again, current realities, and then thinking about the next 12 months, and then even the next 5 years, I think producers are starting to feel a little bit better about what the direction of commodity prices, or at least fewer producers have major concerns about prices getting lower.
And so, David, one of the other things that we asked people on the survey is their expectation with respect to financial conditions the next 12 months. And of course, that feeds off of those commodity prices. So let's take a look at that. So the question is, turning to the general ag economy as a whole, do you think that during the next 12 months there'll be good times financially or bad times? And this is going to report the bad times numbers. So let's take a look at that real quickly. That's from the producer survey, right?
Yeah, so here in gray, the first thing we saw is that the producer survey between in April, 78% of respondents indicated they expected quote unquote bad times financially, thinking about agriculture as a whole, the ag economy broadly. And so while we've seen that improvement in March and April, that short run little blip up in commodity prices, it's important to keep in mind that overall there's still shadows lingering and that producers are still concerned about the overall economy, the overall health of the sector. We also asked the ag thought leaders, a group of 100 ag retailers, ag bankers, ag lenders, ag economists like ourselves and consultants, those in the industry. Throughout our research, we're going to parallel producer results to the kind of ag business thought leaders. So we have that data on here as well. And they're also echoing this concern of bad financial times in the next year. And so, in fact, the last couple months, they've been more pessimistic than the producers. In April, 88% of the ag thought leaders expected bad times financially in the next 12 months. So we've seen that improvement from March to April in that short run blip, but still those long run concerns are still out there.
Yeah, a tremendous amount of concern. If you think about it in round numbers, roughly 3/4 of the producers are expecting bad financial times in the next 12 months. That's indicative of an economy that's struggling a bit, right?
Right. And I think it's when we start to dig into the budgets, I know Michael has a little bit to say about that, it starts to show how we've improved, but we're still not out of the woods yet.
So let's talk about that for a second. One of the things we didn't mention at the outset, perhaps this would be a good time to do it, is the fact that a little over half of the people in our survey produce corn and soybeans. So let's take, Michael, a little more detailed look at returns in the corn and soybean sector.
Before we do that, one of the charts we did not show here was asking people to look at this year compared to last year, and are the times that you're facing worse or better? And overwhelmingly, approximately 3/4 of the survey respondents said they were worse off right now compared to last year.
That's exactly right.
So really what we're looking at here, guys, is about 3 years in a row where times are going to be really tough.
Really tight margins. Yes. Let's talk about those margins.
And so we refer to earnings per acre in the Purdue crop cost budget. So I wanted to clearly define that so everybody knows what we're talking about. And so we take our crop revenue for corn or soybeans, we add to that our government payments, which is primarily through the Ag County program. We add to that any crop insurance indemnity payments, and then we subtract all of the costs. When we're looking at costs, we include both cash costs, but also opportunity costs associated with family labor, associated with machinery ownership, and associated with land that we own. And so all of those costs are subtracted from our revenue, and that's how we come up with the earnings per acre.
All right, let's take a look at the numbers.
This is 4 snapshots of the Purdue Crop Cost and Return Guide that date back approximately when we started our survey for the Ag Economy Barometer. So I've got snapshot here in late October, early January, late March, and early May. And let's start with rotation corn. Rotation corn hasn't looked very good for months, but we can see here that in January things look particularly bad. Things improved a little bit as we got to late March. Again, we're starting that corn price rally. Unfortunately, that rally to some extent was short-lived. And so what we're showing here is even though returns, we don't have it shown on the chart here, but earnings per acre were higher in mid-April, but they've come back down recently. And so the earnings per acre for May 4th are still quite low, negative $135 per acre. Soybeans is a different story. Soybeans started to were negative, but very similar in late October to rotation corn. Soybeans have continuously looked better as we've moved to the current period. And at the current time, there's that $80 to $90 per acre difference in earnings per acre for corn and soybeans. And so that illustrates, Jim and David, the fact that the soybean rally has stuck with us. Part of the increase in corn that we saw in mid-April has disappeared, but the rally for soybeans, quite a bit of that stuck with us, and that's clearly shown here on this chart. But the point that David was making earlier, even though the producers that were surveyed are more optimistic than they were earlier this year, it still doesn't look very pretty.
And I think as you look at those numbers, Michael, the other thing that comes to mind is, of course, we had that acreage planting intentions report that came out at the end of March, showed larger planting intentions for corn than the trade was expecting. And since then, I think a lot of people have backed off those numbers a little bit and actually expecting corn planting to be a little bit smaller than what was suggested in that report. And the margins you're forecasting here or showing us here actually suggest why that would be the case.
Even in the time right after that report, we did a webinar with Chris Hurd, and even at that time, we thought that people would be a little bit too pessimistic with regard to soybeans, and I think that's continued. I think soybeans are getting a closer look now than they were at the time of the report.
And one of the things we didn't mention earlier, but we talked about it in our write-up, David, was the fact that not only did the optimism on the April Ag Economy Barometer was driven by the change in commodity prices, but also the fact that in much of the Corn Belt, planting conditions have been relatively favorable. We've pushed planting above the 5-year average in much of the Corn Belt. And that probably contributed to some of that optimism as well.
Yeah, producers had a lot of luck getting into the field early this year, and they had a lot of good pace, a pretty strong pace heading into the end of April. We also had very timely rains in the western plains, so it helped the wheat crop out a lot. They were getting a little dry. And even if you look at the U.S. drought monitor map, there are pockets of dryness, but we didn't see those really dark areas emerging in the southern plains like we've seen in the past. And so I think a combination of factors. Commodity prices were important. Like Michael pointed out, we can't really understate how important this improvement has been to the corn-soybean rotation contribution margin, but there's been a lot of other factors, and I think just producers had a pretty good run planting-wise and commodity price-wise. I think that we've captured that in the latest data from the Ag Economy Barometer.
When you're able to plant a crop on a timely basis, it improves the prospects or expectations with respect to yields for the year. And so it gets things off to a good start and contributes to some optimism. We don't have a good way of quantifying how much of that came out of commodity prices versus optimism related to planting progress, but nevertheless, those are probably both factors to consider.
I think another factor that's been playing here, and we talked about in our report, is the fact that South America's been having some trouble with their weather. And if that continues, that's going to improve our optimism.
And related to that, of course, that bodes well for U.S. exports as we potentially would gain some export market share. And related to that, obviously, is what's taking place with respect to currency values.
Yes.
Right. So that's also been positive for exports, and that's feeding back into those prices that we've been looking at. So one of the questions we ask in the survey is, over the next 5 years, are widespread good times or bad times more likely? And this chart is focused on the good times. Michael, you want to talk a little bit about that?
Yeah, it's been a trend ever since we started this survey for the percent of the farms thinking that livestock was going to have good times compared to crop has been higher. No surprises here. There's been more pessimism in the crop sector than there has been in the livestock sector, and so this clearly shows that. But another thing that's kind of interesting here, David, is the fact that the spread was really wide in March. And so the real pessimism in crops is showing up on this particular slide, and then improved dramatically as we come to April, whereas it's relatively flat movement when it comes to livestock. And so can you explain that just a little bit more, what's going on?
Yeah, so when we're surveying producers, we ask them the broad question, will the next 5 years in agriculture be good times or bad times? And then we split that up and we let them talk about the differences there. And I think that what we see here is that in general, that pessimism in crop livestock, or that lack of optimism in crop ag, was somewhat building there when we turn into March. And broadly speaking, livestock producers, of course, there's lots of specific animals and lots of specific production systems that go into that. But broadly speaking, the sentiment has been that for livestock producers to have experienced good times, both currently and over the next 5 years. So the thought was that livestock producers would probably have a little better run at the next 5 years than crop producers. Of course, that's a broad measure. We were talking about in preparing for this. In some areas, cow-calf, for example, has been pretty good, but in other areas of the livestock economy, it's been a little rougher.
So that kind of wraps up our discussion. David, have there been any questions that showed up?
We don't have any here right at the moment, but we encourage you to email those or call those in to us. And of course, we'll be sticking around our emails for the rest of the day, and you can always email those to us as we move forward throughout the day.
So that email address to pose questions directly to us, Ag Economy Barometer at Purdue.edu, and we will be monitoring that not only today, but on an ongoing basis. So if you have a question about the barometer, feel free to go ahead and pose that, and we'll look forward to capturing that information and respond to you directly.
So one of the things we'd also like to add is that moving forward, we're going to continue to do this survey This is the first snapshot of the results, and so we'll be continuing to do the monthly producer survey. So for all the producers out there, we thank you for agreeing to do the survey ahead of time. We appreciate that. And then we'll be writing monthly reports, discussing the results, the latest data that we see, and then we'll be rejoining you guys every quarter. So the next quarter will be in July. We'll be sitting down again and having another webinar, or I guess August, we'll be having another webinar to discuss the latest results. So that monthly report and the quarterly webinar is what you guys should be looking forward to.
The monthly report will typically be in the first week of each month, and so that's kind of the time frame that we're working with here. The survey is conducted about the third week of the month, and then it takes about a week or two to get the results summarized and make sure we've got everything right. And so the first week of the month is when we typically release the report. And so I'll be looking at that on the website for the Ag Economy Barometer.
Yeah, so first Tuesday of the month is when the report comes out, and keep an eye on that. So with that, we thank you for joining us today, and we look forward to catching you on future webinars, and also by way of email, etc. So thanks a bunch for joining us.